I would like to consider the basics of bond investing, the basics of investing in bonds, how to build a stable portfolio. And bonds are debt instruments or debt securities and issued by governments, corporations, or other entities to raise capital. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value upon maturity. Let's highlight the key features of bond investing. Number one is fixed income. Fixed income. Bond provides regular interest payments known as coupon payments, which are typically paid semi-annually or annually, as it is paid once a year or twice a year. Number two is maturity date. Bonds have a specified maturity date when the principal amount, that's the face value, is repaid to the investor. It might be sometimes 1 year, 3, 4, 5, and even 10 years and above. So that's the maturity date. Number three is face value. The amount paid back to the investor at maturity, is what is called the face value of the bond. Number four is interest rate. The coupon rate at the interest rate paid, is the interest rate paid on the bond's face value. It is fixed or variable depending on the bond. This is a kind of interest the bond attracts, a kind of coupon. Number five is credit rating. Bonds are rated based on the issuer's, credit worthiness. Higher rating indicates lower, higher ratings indicate lower risk, while lower ratings indicate higher risk. So usually, no two issuers are the same. They have a blue chip company issuing bonds is different from a not all that popular company issuing bonds. So they have their individual credit ratings, who will tend to attract investors or even repel some investors. Number six is market price. Bonds can be bought and sold on the secondary markets, and their pricing can fluctuate based on interest rates, credit risk, and other factors. When you buy bonds, you may decide to discount, you may decide to sell your bonds before the maturity date, and that could be done even in the markets. In the secondary market, you can sell your bonds at the prevailing market price. We want to consider the benefits of bond investing. Number one is stable income. Stable income. Bonds provides predictable income through regular coupon payment, which can be attractive for income-focused investors like retirees. The interest on these bonds, they come in regularly. Number two is capital preservation. Capital preservation. Generally, less volatile. They're generally less volatile than stocks, actually. So making them suitable for conservative investors seeking to preserve capital. You don't want to lose your money. You are afraid of the risk and the volatility in the stock market. Then you could invest in bonds. Though the returns are usually very small relative to what is obtainable in the stock market. So it's there for capital preservation. Number three is diversification. It adds diversifications to an investment portfolio, potentially reducing overall risk. So you could diversify from your traditional investment portfolio by including bonds in your asset mix. So it provides a means of diversification. Number four is predictable returns. That's a very important benefit of bond investing. It offers a fixed return on investment if held to maturity, assuming no default occurs. If the issuer does not default, then you are always going to get your coupon coming in at regular intervals. You know. Number five is variety. They are available in various types, such as government bonds, municipal bonds, and corporate bonds. Each with different risk and return profiles. You know, I think government bond is the less risky. Attracts lesser level of risk. Then the drawbacks of bond investing. You have number one, interest rate risk. Bond prices can fall if interest rate rises, as newer bonds with higher rates becomes more attractive. So there's that inverse relationship between interest rates and bond prices. Number two is credit risk. The issuer may default on the interest payment or repayment of principal, particularly with lower rated bonds. There's always that risk that the issuer may default, the company may go bankrupt. Even the government can default, on their obligations to their bondholders, to its bondholder. Number four is number three rather is inflation risk. The inflation can erode the purchasing power of fixed interest payments, affecting their real return. If the inflation rate is more than what you are getting as interest, then such investment is considered, unproductive. It's not worth undertaking. Number five is liquidity risk. Some bonds, especially those issued by smaller entities or those with long maturity, may be less liquid or high, maybe harder to sell. Although you could, there's that avenue of selling off your bonds if you don't want to hold it to maturity, but I need to ask yourself, are they ready buyers compared to what is obtainable in stocks? So that liquidity risk is always there. Can you very easily sell your bonds? You look at most of the bonds traded in the Nigerian market, you discover that when you go to to pick an individual bond, you can hardly find buyers there. So you need to wonder how bondholders are able to dispose their bonds. I don't buy bonds, actually. I don't know how they cope. So types of bonds, when we look at different types of bonds, you have the government bonds, issued by national governments. They are considered less risk. Example is the US Treasury bills, the German bonds, the Nigerian, green bonds, and bonds from other countries. Number two is the municipal bonds issued by states, cities, or other local governments or municipalities, often tax exempt, making them attractive to high income investors. Number three is the corporate bonds. These bonds are issued by companies to raise capital, to fund their operation, to fund their expansion, or to invest in research and development. And they offer higher returns compared to government and municipal bonds. You have number four is treasury notes. These are short-term government bonds with maturities ranging from 1 to 10 years. Within 1 to 10 years. Number five is treasury bills. Short-term government securities with maturities of 1 or less, typically sold at a discount to face value. This has a smaller, kind of a maturity period, less than 1 year. Number six is high yield bond or junk bonds. They are issued by companies with lower credit ratings and higher risks, offering higher interest rates to compensate for you know the increased risk investor is is bearing or choose to bear in this investment. Number nine is convertible bonds, corporate bonds that can be converted into a specific number of shares of the issuing companies or stocks. So these are, different types of bonds. So bonds can be a key component of a diversified investment portfolio, offering stability, income, and various risk return profiles. However, it's important to consider their risk and how they fit into your overall investment objectives.